right, folks, welcome to the broadcast. My name is David Lincoln, and seeing as my P&L isn't doing so great today, I figured we could check out something more exciting than that. Let's take a look for a second at some charts. Now, UVXY, people ask a lot about what it is, where does it come from, how does it trade. It's kind of a focus of my channel here. And, you know, the best place to find out about an ETF can often be the website for the ETF. So let's take a look at the ProShares website. This is going to give us all kinds of information. And currently, this is the daily holdings of UVXY. And you can see it's got some of the September futures and the October futures, mostly September futures, 29,000 of the September futures, 7,900 of the October futures, and then some swaps here. And right now, the swaps are a small percentage of what's going on here. Now, when we look at these futures, a lot of times we look at a VIX term structure, it's called. A lot of people use VIX Central. And this is going to show these two futures and kind of where they are in relation to each other and also to the spot price of UVXY. And we talk about how the point of UVXY is to maintain a 30-day out snapshot of volatility. So you have these futures and they're set in time. They expire on a specific day in time. And so none of the futures actually maintains a 30-day window to view things from. So what we have to do is we have to combine two futures to in a certain proportion to average them out so that we have 30 days out, a 30 days out viewpoint of the VIX. And so every day we get rebalanced, and UVXY changes its composition a little bit to so that the average maturity of the combination of these two futures equals 30 days. So on the first day, the September future had 30 days till expiration. So UVXY was composed completely of just the September future. The next day, the September future, now it only has 29 days till expiration, so we have to add a little bit of the farther out future, the October future, that has something like 59 days till expiration. And by combining the two, we get a maturity of 30 days. And that's sort of the way we describe how UVXY works. However, there is an index published that conveys the same information, and what it does is it takes a blend of these two futures and it does the math, and it displays a value based on the right blend of these two futures. And that is what UVXY, that's what basically market makers make markets around for UVXY. And now the name of this particular index, and you can pull this up in the prospectus for UVXY, but just to save you time, it's called SPVXSP.ID. And that's a mouthful. But what this does is it is a chart of tracking a price for the blend of the two futures that makes up, that adds up to a 30-day snapshot of the VIX. So I wanted to go over and just look at some charts here for a second, because remember, UVXY is leveraged by 1.5 times. And when we have a leveraged product, they decay over time due to compounding and rebalancing. In my head, I like to think about it as, okay, well, if you have let's use 2 times leverage future, for example. As the end of the day comes, they need to reset it so it represents 2 times whatever the underlying stock or index is. And so if one day the ETF has gone up, then they need to buy a little bit more to rebalance it. So if you have a situation where one day UVXY goes up and they have to buy a little extra, and the next day it goes down and they have to sell a little extra to keep the right proportion of leverage, then you have a situation where you're basically buying high and then selling it back out a little bit lower. And that is sort of a negative scalp, and that causes decay over time. Now, this kind of decay is obviously way more extreme with like triple leverage funds, but still a 1.5 times leverage fund exhibits it. And the way we can see the decay is by comparing UVXY to its underlying index, and over time, UVXY is going to underperform that index, and that is by isolating that amount of underperformance, we can isolate the beta drift for UVXY. So let's pull up some charts and take a look at this graphically. Okay, so I'm in Thinkorswim here, and I've gone to the chart selection. Then I'm going to go up here to the corner, and I'm going to select there's a little grid here, and you can select which way you want some charts. So I'm going to select this so that it's 4 in a row down. What did I just do? I don't want that. So I'm going to select so that it's 4 in a row down with these charts like that. So here we have 4 charts. And we could actually just start with 2. Let's pull these bottom ones down a little bit to start with here. So the first chart will have UVXY, and we could maybe just switch this to virtual account for some reason. All right, there we go, back. So let's put UVXY up here, and we will set it to a 180-day chart. Now what we can do is we can pull up that underlying index. And I'm going to type that in down below here, SPVXSP.ID. I guess I could have linked that as well. So, and then UVXY on top here. And what we'll notice is that, of course, they look very similar. They have slightly different numbers associated with them. And let's make sure that we have the right time periods. So that doesn't look like the right time periods. Let's see. Let's go to 1 year. 1 year and 1 year. All right, so if we look at these two charts together, they look rather similar. And maybe we can just isolate this down to 2 again for a second. And they have different numbers, but they look rather similar. But what you'll notice is that over a year time period, the index went from 76 to 42, whereas UVXY went from 94 to 35. So UVXY has gone down more than the index has over a period of time, and that is due to this slippage. And if we move this out to 3 years, you're going to see it even more here. And if you look at 3 years, UVXY has gone from 2,600 to 35, whereas the index has gone from 250 to 42. So UVXY has gone down a lot more over a period of years, and that's due partially to the fact that it was 2 times leveraged until 2019, and then it switched to 1.5 times leverage. But let's take a look and overlay the charts on top of each other to see if we can get a better viewpoint of this. So let's just go to one chart here for a second. And we can, let's take this underlying index, SPVXSP.ID. That just rolls off the tongue, doesn't it? And let's overlay UVXY. So I'm going to go to Add Study, compare with custom symbol. Add Study, compare with custom symbol. And we'll add UVXY. Okay, and you're going to see, let's go to a different time here period here. Let's go to 1 year. And you're going to see part of this is due to the leverage, right? So when we get a big up move, UVXY actually is going to perform slightly better than the index. But you're seeing over time, it's starting to lag more and more. And this is over a period of a year, but it's starting to slowly diverge to the downside from the index. And this difference between these two is isolating the drift that is caused by a leverage, the fact that UVXY is 1.5 times leverage. And over time, these are going to drift farther and farther apart. This is a year chart. If we close up a little bit, it's going to kind of center them together as we close in. It's going to pull it up towards SPVXSP just because this charting software is going to try to match them very closely to each other. But as we use more time, we're going to see that it's pulling away from each other. And actually, to do the math, what we can do is, if we want to look at a specific time period, we can see what's the percent down move, or what's the percent move in the index, and compare the percent move to UVXY to see the actual amount of drift. But let's take a look at this on the 3-year chart and see what it looks like with that. On a 3-year chart, you can see it's really starting to lag more and more behind the index. And once again, this index is going down due to contango and basically due to contango in the futures. However, the UVXY chart here is going down even more, and that difference between the two is what we call beta drift, or has to do with rebalancing in a leveraged ETF. Now, you'll see, if you read the perspective of any leveraged ETF, it'll say, this is not to be used for long term, it's only to be used short term. And I've actually had people comment on my posts in like the volatility Facebook group and stuff. Oh, UVXY is not meant to be used for more than 1 day. You're misusing it if you're either long or short it for more than 1 day. Well, actually, the reason why we are shorting it over time is to take advantage of this beta drift here, right, that we see. And so, yes, we're aware of the fact that this is one of the principles of a leveraged ETF, is that it's going to not perform as well as whatever it's based on over time due to this beta drift. And so that's why there is some advantage to being short this. So I'm not sure if this all is making any sense to you, but how does ProShares construct the 1.5 times leverage? Okay, so beta drift is going to be strongest when you get severe moves in one direction, and then so if you get a severe up day followed by a severe down day, followed by a severe up day, followed by a severe down day, that's when it's going to be at its worst as far as decay. And actually, there are scenarios where this decay is actually not even going to happen, and the reverse can happen. It really just depends on the path of the way these things close every day. But in general, over time, it's going to decay lower, and that's just kind of the way it works. I wanted to discuss VVIX for a second with you. And I know a lot of you have heard all this stuff before, but the more times we review it, hopefully it helps people to understand it better. Let's talk about VVIX for a second because I don't think we need to overlay VVIX on anything. All right, so we can see this peak in VVIX, which was that Vomageddon. All right, so what is VVIX? You hear about it, oh, it's an indicator, this and that. VVIX is the volatility of the options on VIX futures. And I know that's a mouthful, but if we pull up, if you were to just type VIX into Thinkorswim, and you were to pull up options, you would find options on different VIX futures. And it's very important to remember with these that if you actually do trade these, you want to hedge each month with its corresponding future. You don't want to start mixing and matching calendar spreads because it gets very convoluted. But these are options here that I'm showing you are based not on the VIX because we know we can't trade the VIX, but these are based on VIX futures. And so if we look at the VIX futures, which I have listed on the right of my screen over here, and we can pull that up. Let me just switch screens here so you can see that a little bit better. All right, so these are on my watch list here, these VIX options. This is the VIX futures. So this is the SEP, OC, DES, VXX19, Z, and these are just all the different futures moving out into next year, January, February. So it's going to be SEP. The front month is September, October, November. Z's December. F20 is January, and G20 is February. These are all the VIX futures. There are actually options specifically on these futures, and the screen for those I'm showing you right now. Now, if there are buyers in these options, then the volatility level for this stuff moves up, and you can see to the right of the screen here, you can see these numbers for each month. It's just like any other option screen. When there are buyers in these VIX options and volatility goes up in these VIX options, it's going to be reflected in VVIX going higher. So essentially, a lot of people will come in with hedge funds and things like that who want to protect themselves from a big down move. And so a common way to do that would be to buy out of the money calls in VIX. So the VIX right now is trading, it doesn't trade, but the VIX number right now is 2041. And so if we were to look at, with VIX at 20, maybe to protect yourself, maybe you're going to buy some 25 calls a few months out, right? So that way, if there's a big pop and something bad happens, you're protected. You might want to actually buy even farther out of the money calls, like the 30 call. So if something huge happens, you're at least stopped out with a VIX 30, and it's going to hedge against a long equities position. And we can see the open interest in here today, 2,000, 1,000. And actually, so if we look at the VVIX today, it's actually down on the day 105. Now, people talk a lot about an elevated VIX, and I know it sounds interesting, like 100 would seem like an important number just because it's this round number, 100. But for me, the number isn't as important as the movement. Of course, many people will say like a VVIX over like 110 is in the danger zone. And that's generally true, but we could find a period now where VVIX is elevated for a long period of time, and then it becomes less significant. To me, it's more significant to see a move in this one way or the other, a bigger or smaller move. If we look at VVIX over the past, let's look at it over the past just 20 days here, we see several moves from like 100 to 115. It seems to just be going back and forth in this range from 100 to 115. And this is all pretty elevated. However, it's just as significant if VIX is like in the 80s, VVIX is in the 80s, and nothing else is going on in the marketplace, and all of a sudden VVIX pops from like 80 to 85. That could be as significant a move as this going from 104 to 110. It's something that is going to give you an idea of the implied volatility in VIX options on futures. And so it's not anything really that esoteric or anything like that. It's pretty simple to understand the VVIX. Different people use it as an indicator in sort of different ways. I don't find it all that significant. It's not like seeing the VVIX, it's not like it's going to lead everything. Sometimes the VVIX is going to lead a move in volatility, but other times it's going to tail it, or it's going to happen at the same time. So it's not all that useful to me, in my opinion. All right, so let's take a look at the term structure really quickly. And for that, we'll go back to VIX Central here. So as we see another little sell-off today, we are back in backwardation, and we are back in a situation where spot is above all the futures. However, that being said, we are relatively flat here, but and there's been much said about how, well, maybe the VIX is not is not as high as it quote unquote should be based on how much the underlying indices are moving around. How much the actual S&P moves around is what we call realized volatility or historical volatility. Hi, Sean S. Thank you for your question, and I hope that helps you out a little bit. Sean S. in our group on Facebook had posted this post asking about VVIX, and I hope that helps a little bit. This is just shameless spamming for everybody to check out our group in Facebook. Here it is, right here's Sean's post right here about VVIX. Thank you for your question. So there's been a lot said recently about how the SPX is moving and having a realized volatility that is higher than what the VIX is representing on many days in the recent past. We've seen a couple like 2% moves, and thus VIX should, quote unquote, should be higher than it is right now. And I think if VIX is going to move to a higher, long term to a higher area, that will be reflected in the longer term future. So we'll start to see the longer term futures move higher. And indeed, we actually have seen that. Longer term futures now at about 1950. If you looked a couple months ago, they were lower. And when we would get spikes, the long-term futures would stay in the mid-17s, and stuff would move up from there. So I think we are seeing this curve adjust a little higher right now. Whether that will stay there remains to be seen. But really, between backwardation and contango, it's really kind of a moot point right now because we're showing backwardation of 0.75%, less than 1%. We've been bouncing in between with a very flat curve. So the curve doesn't really know what it wants to do right now. I think the longer we have days where the VIX closes above 20, the more these back months are going to get pulled up. And I kind of always like the back months being pulled up because it means that once we do go into a period of a rally for a while again, the back months are starting at a higher spot, and thus you can, as the front months start to curl down, you can have higher contango for longer periods of time. So November, all these futures after October have no bearing right now on UVXY. Now, the November future, as we get closer to that coming online, is going to have some effect in the index, I believe. Number crunchers can correct me if I'm wrong. But for all intents and purposes, for UVXY, the SEP and OCC futures are the only ones involved. When we looked at the daily holdings, those are the only two futures that are being held. and thus it would be nice if any of these other futures behind those two started out really high, because then as we come back into a rally mode for the market, it creates a steeper curve, a steeper contango. So I like when those futures move up. Right now, we are kind of in a little bit of a no man's land with the market. We've had that sell-off, and we're just kind of in this range. Let's take a look for a second at the E-minis. And this is sort of the Don Kaufman volatility box that they've talked about in the Theo Trade show. You can see it just keeps bouncing off this 29.30 level, and to the downside, well, what does it look like? 28.20. And we don't know what the algos are actually doing, which it's widely publicized that algorithmic trading has been driving the market lately. We don't know exactly what these algos are doing, and but it appears that they are buying when we get to the low end of this range and selling when we get to the high end. Let's back this chart out a little bit. Let's look at a 180-day chart, and you can see once again in this little box here. Now, will we bust out of it? It looks like we bounced off the low end pretty big a couple of days ago, but will we test the low end again? It remains to be seen, but it definitely seems that volatility is not coming in real quick when we get these little rallies. So there's nervousness out there. I think it's next week that China's supposed to, the tariffs are supposed to come online September 1st. I think that the U.S. and China are going to be talking ahead of that date. I would look to see either the U.S. or China to delay these tariffs coming online on the 1st, and that could be a potential rally for the market. But things are not looking great in this market. It is a tradable market, though, so I don't really believe in the fact that, things don't look good for the market, so just take your ball and go home and take your positions off, and I'm just not trading right now. Some people will do that, but I think there's opportunity when people don't know what's going on. All right, so there's a little bit. Let's see. Why do I say we're flat when there's a clear steep dip in December? Well, because December is always discounted, and actually it's been more discounted in the last couple of years, but this December is discounted because there are several holidays in that month. And to me, this is a difference of 35 cents. And to me, 35 cents in futures is not a lot. And I see this curve as relatively flat. They do discount December a little bit, but a lot of times you will see, $1 or $2 between the two futures and the two front futures that are online. Right now, the difference between the two futures is 14 cents, which is very small. The difference between spot right now and the front month future is less than 25 cents. So I see this as very flat. Yes, December is discounted, and they have been doing that every year for the last couple years because of that cycle is has a lot of vacation days in it. But I see this as relatively flat. Here, if I press this button, it even looks more flat. I don't think we get a lot of information out of this. If you look at these numbers down below, month 7 to 4 contango, 1.4%. That is relatively flat here. So what this curve would really like to do is it would like to have spot go to 18 and then rearrange itself back into contango. But now we're in this elevated state. And as I said before, the longer we stay in an elevated state, these futures are going to get sucked up towards spot. If spot's not moving, then the futures are going to get pulled up towards spot. And that's just kind of where we stand. This curve, it wants to, over time, if nothing else moves, it wants to arrange itself into that contango shape. It's pushing to do that. So But the fact is that the spot's moving all over the place, so it can't get itself into that contango state. But this curve would like to arrange itself in a perfect world. If spot were not to move from here, these futures would arrange themselves in that contango shape above spot over time. So these futures here are pushing up as we speak. They're trying to push up to get above spot. And I can illustrate that here. These futures would like to just arrange themselves back into that perfect contango shape if at all they could. And if we were to just sit here at 2069 spot for like a month, the futures would arrange themselves above it again because they want to be, it makes sense that the second month future is a higher price than the first month future because it makes sense over time that there's more chance of volatility over a 2-month period than there is over a 1-month period. So this is not a normal state for these futures. The reason that they haven't arranged themselves above spot right now is because the likelihood is that spot's going to go back down from here. But if for some reason spot just stays here, these futures will arrange themselves in a contango shape above spot. Anyways, I hope that helps out a little bit. If you don't understand everything, that's fine. We will recover stuff again. Here's, for a second, barchart.com. One of the things that I had mentioned before about the VVIX is we want to take a look and see where the VVIX implied volatility is coming from. Because it's a different thing if people are buying out of the money calls in the VIX, and that definitely indicates that they're afraid of a down move in volatility. But if volatility is going up because people are buying puts in the VIX, then that doesn't necessarily mean that the market's going to crash. So you want to know where the order flow is coming from. And Thinkorswim does a good job of isolating the top couple trades. So if we were to go to option time and sales, we're going to see the top couple trades. And we can see it's a spread from 951, 38,000 something traded on the spread. So these are SEP21 calls. So if we go to 941 here to find the other side of that spread, and I would recommend to you to take a look at time and sales and try to figure out what's going on here. So here's the spread, this big spread, 941. So we've got the SEP. It looks like they were buying the 16 calls and selling the 26 calls. That's what that looks like to me. So 18 SEP, 16, 21 call spread. And let's take a look at open interest. When we just look at time and sales, we don't know if somebody is rolling something forward. They're taking it off. We don't know if they're closing a position, because right here it looks as though they are buying the 16-26 call spread, right? 16 looks like they're buying the and then there's also a trade on this 21 call. So let's see, 21. Yeah, it looks like they're buying the 16-21 call spread. But let's take a look at open interest in September 18. So if we go to 18 September, look at the size that's traded today. I mean, that's a lot of size in the VIX trading today. So we've got the 21 strike trading huge, the 19 strike trading huge, and the 16 strike trading huge. So this could be somebody, there was already a lot of open interest, so this could be somebody who had bought this call vertical, the 1621, and now they're selling it back out. That's very likely that's what that could be. It's very hard to just look at one trade and tell exactly what someone's doing. Let's take a look at the other big trade that I saw in there. And when you pull up time and sales, okay, this is going to show every month, right? If you want to just isolate the biggest trades, and here's the other one, the SEP16 put 20,000 trade at 950. So let's look at 9. So that's very close to the other trade. So they certainly could be related. So 950. So it looks like they are selling the 16 put and buying the 13 put for a penny. No, it looks like they're selling the 13 put. So maybe they're buying the 18 put, selling 2 16 puts against it. So, you know, essentially the 13, they're buying the 1318 butterfly, it looks like, in the VIX. So let's model the 1318 butterfly really quick here. So they're buying the 18 put. They're buying the 13 put. And they're selling the 16 put twice. And they did it 20,000 times. So if we model this trade, all right, so let's see. So if we model this trade, you're making money between 1450 and 1750. So this trade is actually a bearish trade because they're going to make money if the VIX is back to 16 in September. So that's interesting. Somebody's doing a big trade that's saying that the VIX will be back to 16. So that in this case, this is not a bullish trade. This is a bearish trade. Like I said, it can be interesting to just look at this paper flow because it's going to give you an idea of what people are doing. So that's a bearish trade in the VIX, certainly. Butterfly. 18, 13, fly. When you name a butterfly, you say whatever the wings are doing. So in this case, we're buying the 13 and the 18 puts and selling the guts, and so we're buying the fly because we're buying the wings. That's interesting. Anyways, I'm getting off topic. Interesting. All right. But yeah, it can be interesting. And the other thing you can do is you can select just a specific month, and it's going to give you the top trades just in that month. So everything's been this 18 SEP. Let's look out to AUK for a second, and we're going to see, okay, what's the biggest AUK trades? Well, AUK 19 calls, 306. It's hard to, it's a spread again. So 1219. So let's go to 1219 and look at this AUK spread in the VIX. And, you know, I sit around and just look at these trades all the time just because it's interesting to see what other people are doing. And you can do this just in UVXY as well. But some of the biggest players are going to play in the VIX instead of UVXY. Okay, so they are buying SEP19 calls and they're buying AUK19 calls. So it's the call. Some people would call it the call stupid. So you're buying both. And those are at the money calls, or actually in the money calls now. So once again, we don't know if they are covering a position that they were short and they're buying them back. We don't know exactly what this means. Yeah, VXX is not going to have beta decay because it's not leveraged. So that's good. TVIX is going to have more decay than UVXY did, and I don't have the. If we can pull up let's actually, you know what we could do? We could check out on these charts. Let's check out TVIX versus UVXY. So let's go to 2 charts, and we'll pull up our SP. And I'm not 100% sure that TVIX is based on the exact same index. But let's pull this up, and then let's do a study with TVIX and UVXY. So I'm going to go back here to studies, quick study, compare with UVXY. And right, we should see TVIX even having more decay, because TVIX is 2 times leverage. Okay, studies, compare with TVIX. And once again, I'm not entirely sure that TVIX is the same index, although it makes sense that it would be. So we're seeing, we're seeing more extreme movements with TVIX because TVIX is a higher leverage. So that's interesting. Let's take a look at a 1 year. And you're going to see, yep, TVIX decaying, TVIX being the blue here, TVIX decaying more than the index. So this is even giving percentages here. So with this index down 0.6%, UVXY down 14, TVIX down 33. So we would love to have options on TVIX because that allows us to take even more advantage of this decay. But of course, TVIX doesn't have options, but you could just short TVIX if you wanted to, just short the actual underlying. So that's interesting. So once again, this is the index that underlies UVXY, then the purple being UVXY and the blue being TVIX, and the difference between these is each is beta drift or beta decay. And we could do this with UGAS, DGAS, any other leverage funds we could check out that same sort of stuff on. Let's take a look really quickly at UVXY time and sales and see what is trading today in UVXY. So if we go to UVXY, options time and sales. So we've got, I tweeted about this before. They are selling essentially strangles, and they were selling different ones too. They sold the 29 puts also, but look, people are coming in and they're just selling strangles. And if we just put which basically means that this isn't going, in these people's opinion, this isn't going too far in either direction. But you know, they are getting kind of burned on this one to the upside a little bit because we have broken through 35 strike. We'll see if we end the week above the 35 strike, but here we go. As we speak, UVXY is getting cranked up again. We can see VIX now up 131, and my buddy Brent with MarketWatch, we have to congratulate him for the trades today from MarketWatch. Check this out. What a great call by MarketWatch. Let me pull this up for you really quick. No, it's not going to work. But anyway, MarketWatch signal for people to buy gold and bonds today right on the open, and that would have been, both would have been good moves. Look, gold up 14. Gold up 14 and TLT up 2 and change. So you should check out MarketWatch on YouTube and check out his stuff. He's right in tune with things today, recommending people buy gold and TLT and get out of these short volatility trades for the time being. As we see gold and bonds yields going even lower today. So how do you know that they're not buying strangles? Oh, that's a good question. Well, in a sense, somebody's buying strangles, right? But because it's a two-way trade. But the way I know, I'll show you here, is because you see how these are red. That means that the customer was a seller. They hit the bid, and also you can tell from it shows over here. Here was the market, right? That was the market at the time, and these traded 126. So it traded a penny below the bid. So they probably said, well, we'll honor the bid for 100, but if you want all 300, you can sell them at 126. So we know that's how we know that it was a seller. Usually red means a seller, green means a buyer, and yellow means mid-market. Both of these, also this one, market's 59.60, which is a pretty tight market. They trade 459. And that's kind of how I know that the customer was selling them. There's this other interesting option statistics that shows, it's going to show how many traded at the bid or below, how many traded at the ask or above. And you know what? Usually when I look at these things, they all are like pretty even in every single stock. Usually when you look at these particular stats, it's not that useful. So, I mean, in this case, you can see puts 42% traded at the bid or below and only 25% traded at the ask or above. So that means there's more put sellers than buyers right there. But these, like I said, these stats can be a little sketchy at times. A lot of times with actual stocks, a lot of these will be like not available or something. VWAP is always interesting, the volume weighted average. That's going to show where most of the trade in UVXY happened today. Now, I'm not interested that much in actual UVXY underlying volume because there's so many other things that are going to move the price of UVXY. It's not a supply and demand issue like Apple is, so I don't follow too much supply and demand in the actual underlying. Let's go and just talk about the position for a second because might as well, but I'm not liking my position right now. So what I ended up doing was I had kind of a shorter term position. I did have the I had a 20 SEP position on that expires in 24 days. I didn't like that. It felt like it's getting too close, and so I did roll it out to November, which is 80 days out. I did do that earlier today, and the position hasn't done well today, but at least I've given a lot more time, and so now I can really set it and forget it and just leave it for a few weeks, and we'll see what happens from there. But I wasn't liking 24 days to go, and there was just too much pressure on the position for something to happen to the downside for us. So we did roll it out to November, and that did reduce our delta a little bit, which is, I guess, helpful for this up $2 move. But position not doing great today, of course, with the up move. So we'll see what happens moving forward today. And I hope that gives you some ideas. Dave, when are you selling at the money call, aka Bullseye? I actually switched out of doing the at the money strategy for this position and actually have a long put spread on. Certainly you could, I would have done better if I'd stuck with that. Just feels very turbulent right now. I would say if you're going to do the bullseye thing, just to stick to it, just to actually execute that position and just stick to it. But in this case, I didn't do that. And that's kind of where we are right now. But you certainly could initiate a position right now. The at the money, we've got 3 days to go, so I would probably do the second week and just, the at the money is way up here at 36. So you could sell one of the 36 calls for every like $4,000 or $5,000 in your account, and then hang out and just look to roll that to the next week 36 if at expiration next week we are above 36, and if not, to let it expire worthless, and then that next Monday to just sell an at the money call wherever the at the money call strike is then. on a spike, I mean, it works better on a spike, because if you sell that at the money call on a spike, then it seems that we will be lower than within the week. So, yeah. Most of the time we're not in a spike situation. Right now we're in kind of a dramatic situation in the market, and so the rules change a little bit, certainly. I mean, we're back up to 36. This is extraordinary times. Let's take a look at UVXY over the last 20 days, and we see the initial spike, and it seems like we're having lower highs, but it's taking some time for this to dissipate. I mean, it's been a month, and we're still quite elevated. So look at this down move to 29, and now we're back in. Looks like a new spike to me, right? But this is opportunity here, I believe, to short this stuff. So that's where we are. All right, I'm going to end this now because it's been a while on this show, and 50 minutes is a long time for people to sit through, and I do appreciate everybody sitting through it. Would you wait for 43 UVXY and do the bullseye or risky? I think the higher UVXY goes in a spike, the less risky it is to sell at the money calls. Seasonally, this is a bad time of year. There is some seasonality, but I don't put too much into seasonality because it does vary by year. And I'm not going to be of the situation that like, I'm not going to trade this year or for the next 3 months because of that season. Get a haircut. Thank you, Al. All right, guys. Thanks for watching. I'm going to let you get back to it, and appreciate everybody's support. If you want to give a buck or two on Patreon, that's much appreciated. And please like and subscribe for videos and more content. Check out the Facebook group. Follow me on Twitter. Ask any more questions you have, and I will answer them in as quick a period as humanly possible. But in the meantime, I'm on set and forget mode and just leaving the position, and we'll see what happens moving forward. Set them and forget them, folks. Thanks for watching.